Welcome, ladies and gentlemen, to Commodity TV, and a happy new year to everybody who is watching and listening to us. And yeah, it's my honor and pleasure. The first interview this year, the first online interview with David Garofalo, the CEO of Gold Royalty. Welcome, David. How are you?
I'm well, thanks, and Happy New Year.
Happy New Year to you as well. Thank you very much for taking the time. We were already talking a lot, but now we are in the recording here, which is great. I'm a shareholder of the company. I want to disclose that upfront, of course. And yeah, it's to me a real honor and pleasure also because let's talk about your $40 million strategic convertible debenture altogether, which you did with Queens Road Capital. I'm a shareholder of the company too, of course, and I know you, Warren, and you know each other a long, long time. So that is a big deal. Can you explain that a bit to us? Where do you see the real big benefits?
Well, there's a couple of benefits, and it's not just Queens Road Capital. In
Hmm.
fact, 30 million of that financing came from QRC, Queens Road Capital. Another 10 million came from Taurus out of Australia. So we have two significant strategic investors taking an important stake in the company to not only put cash on the balance sheet, but actually to finance an acquisition.
Hmm.
We
Hmm.
acquired for just over $30 million a royalty on the Borborema gold project in Brazil that's operated by Aura, which is a long life operation and will be paying royalties to us on a prepayment basis immediately.
Hmm.
So the mine is likely to be in production late next year. It's already under construction and will be producing royalties for a very long period of time, for decades, in our view, given the longevity of the deposit, but also pays us royalties on a prepayment basis now. So we get immediate cash flow and we get very significant capital provided by sophisticated investors who
Hmm.
typically invest in the mining business day in, day out in Queens Road Capital and Taurus.
Okay, super. Yeah, I mean, honestly, I really like the deal because, as you said, immediate cash flow on the one hand, but on the other hand, I like also this convertible gold-linked bond because when we look into the how can I say that? If you look into the conditions here, what I like is the buyback option upon the conversion because when I calculate 0.5% NSR on 2.25 million ounces payable, that would mean that is 10,125, right? Times 2,000, that's yeah, a good, what is it, 20, 22, $23 million. And we talk here about only 10 million.
Yeah, and so it supplements what's already
Yeah.
industry leading growth in revenue
Hmm.
in the royalty space. We had, even before this acquisition, 60% compounded annual growth in revenue right through the end of the
Hmm.
decade. This year alone, we're going to see our revenue double,
Hmm.
not only because of the Borborema acquisition, but also Cote, which Iron Gold operates in Northern Ontario in Canada, is coming into production in the first quarter of this year.
Hmm.
And that presents a meaningful leg of growth in our revenue this year. And we continue to have steady growth in our royalties from Canadian Malartic as they mine more and more production from underground, where we have significant royalty coverage.
Hmm. Okay, super. So that means, yeah, more and more mines are going online over the next years. As you said, this is why you have that revenue growth, of course. But I think on the other hand, you brought down your cost basis also significantly, right?
Exactly. We actually went to free cash flow neutral territory in the second half of 2023.
Hmm.
And that was a result of some revenue growth from a number of our assets, but also meaningfully, we brought our operating costs down 50%
Hmm.
year over year as a result of the integration of the three companies we took over in 2021. We completed the post merger integration,
Hmm.
which means we delivered significant synergies through containing costs from those companies that we took over. So now we're at a sustainable cost structure that puts us in a position to generate free cash flow for the first time in 2024,
Hmm.
which will only grow exponentially over the course of the next several years as our revenue grows. So all that incremental revenue growth that I was talking about earlier falls right to the bottom line because our cost structure is stable and low. We operate a virtual business. We don't even have an office. I work out of a corner office in my house. Our head of corporate development does the same in Toronto. Our CFO operates out of his home here in Vancouver as
Hmm.
well. So we keep a very, very lean, low cost structure with very few heads. and that results in significant not only revenue growth but free cash flow growth, as that revenue growth falls right to the bottom line with that stable cost structure.
Fantastic. And you will keep that cost structure, right?
Well, that's the beauty of our business. It's eminently scalable.
Mm.
We can run a business with 10 times the number of royalties with the same number of people.
Mm.
We have over 240 royalties today. We could have over 2,000 royalties. I wouldn't have to add an additional headcount.
Absolutely. Just yeah, that you are saying that, I found that also interesting in your press release from 14th November last year. You acquired a portfolio of royalties from SOCAM, the Société Québécoise d'Exploration Minière, and which is a subsidiary of the Investissement Quebec. I think this is the one of the largest investment companies in Canada for mining, definitely. And you paid 1 million Canadian dollars in common shares only. So what does that portfolio look like? Is it early stage only, or is it something also in where you would say, you know what, in the next 3 to 5 years, there could be already something in which is cash flowing then?
Certainly, there's a number of them that are earlier stage. There's a couple of dimensions to this transaction that are really, really quite attractive. One is SOQUEM, many people don't realize, is actually an arm of the Quebec government,
Hmm.
the province of Quebec. They're the investment arm that's focused on early stage exploration. In the course of funding early stage exploration in mining projects in Quebec, quite often they get paid in royalties.
Hmm.
And we, through our relationship, I've been operating in Quebec for over 30 years, through our relationships
Hmm.
with SOQUEM, we approached them about monetizing their royalty portfolio that had accumulated over many, many years. They spent about a year going through their royalty portfolio, understanding what they owned so they could put a value to it. And they traded it to us, not for cash, but for an investment in Gold Royalty, because they believe in the intrinsic value of our business, the re-rate potential.
Hmm.
And so they now have become a strategic investor in Gold Royalty Corp. And what that also provides us is a conduit for future royalty opportunities that they generate through their exploration activities. As they finance
Hmm.
more exploration in Quebec, they're likely to create more royalties. And now they have an avenue in which they can monetize those royalties so they can reinvest back in exploration, which is their fundamental core mandate. So that's really the attractive part of it. The other attractive elements of this portfolio is there are $18 million of partial buybacks on those 22 royalties. So, in other words, if the underlying operator of those operations want to buy back upwards of half of their royalties, they would have to pay us $18 million. So
And you
that
paid
means that
one
$1 million
only.
investment, even if those royalties don't ever come to
Yeah.
fruition, could ultimately turn into $18 million in the worst case scenario. So we have really fundamentally strong royalties on good property positions with senior operators in
Hmm.
Quebec, but buybacks that actually deliver significant value growth and returns for our shareholders if ultimately those operators decide to at least partially buy back their royalties. So we have that optionality by retaining at least a partial royalty in these projects, but also we're going to see an 18-fold increase in our investment
Hmm.
if, in fact, they do decide to buy back at least a part of those royalties.
It doesn't matter what happens, you make money.
That's the beauty of it. And I think importantly, we've now established a relationship, a
Hmm.
conduit for SOQUEM to generate further royalties
Hmm.
for us and sell them to us down the road. Now that we have that relationship, we have that template about how we transact,
Hmm.
then we're likely to be able to do more transactions with SOQUEM down the road. And in fact, what I hope we can do is emulate that with other provincial governments in Canada who quite often fund exploration and are dealing with a portfolio of royalties they don't know what to do with.
Hmm.
The governments are really not set up to manage these royalties. We are, and we can provide them an exit strategy for those royalties that provide optionality at very, very low
Hmm.
cost to our shareholders.
Okay, cool. I also saw that you have done a deal last year with Capstone. They are
That's right.
more famous for copper, and I see also the name of Endeavor Silver here in it. Can you comment a bit on that deal, and where do you
Yeah,
see, the benefits here for the shareholders?
so Capstone has had a long dated copper mine in
Hmm.
Mexico that they've been operating since 2006.
Hmm.
Started out with 6 years of reserves,
Hmm.
and here we are almost 20 years
Yeah,
later. It still has 6 years of reserves ahead of it.
yeah.
If you include the resources, it has actually more than a decade of mine life ahead of it. Endeavor Silver had staked properties around around that mine, and it vended them to Capstone and got a royalty back in return. So it was non-core to Endeavor Silver. And so that presented an opportunity for us to buy that from Endeavor Silver and introduce another cash flowing royalty into the portfolio immediately on a very low cost, high grade copper silver mine in Mexico.
Okay, perfect. Um, for this year, what do you think we can expect as shareholders? Where do you think the journey will lead us?
Yeah, well, we're looking for a doubling in our revenue. And now that our cost structure is quite stable, we've again delivered the synergies from the integration of three companies that we acquired in 2021 and saw a 50% decline in our operating costs to between $6 and $7 million per annum. But our revenue is growing to over $12 million this year. So that we're going to position to generate significant free cash flow.
Hmm.
And given the stability of our cost structure going forward and our 60% compounded annual growth in our revenue right through the end of the decade, you can imagine that a free cash flow generation over the course of the next several years will be immense.
Hmm.
And so returning capital to shareholders at some point certainly makes some sense, whether we look at dividends, whether we look at share buybacks. It's something, a conversation that I know my board would be delighted to have when we get to that point.
Hmm.
And when we have something to communicate to shareholders, we certainly will. But we certainly have the capacity to look at returns of capital to shareholders as we crystallize that growth over the next little while.
Okay, super. Last but not least, as you are, yeah, long time in the markets, you are long time in the mining. What is your view currently on precious metals markets, and what metals do you think are favorable this year?
Look, I'm a big proponent of both gold and copper on the base metal
Hmm.
side. Not coincidentally, I've spent equal amounts of my 33-year career in both precious and base. I've built a lot of copper mines, built a lot of precious metal mines, but I think fundamentally they're well supported. On the gold side, the pivot by the Federal Reserve was inevitable, given the amount of debt globally that's been strapped on
Hmm.
since the great financial crisis, only exacerbated by the COVID crisis that we experienced the last several years. So the debt levels are not sustainably serviceable
Hmm.
right now for
Yeah.
at either the government level or the individual level. The Federal Reserve has to pivot. They have to reintroduce inflation to the market so that debt levels on a per capita basis start to come down. There's no fiscally responsible way for these governments to repay the debt. So they need to
Hmm.
effectively inflate it away. They need to make the debt a smaller component of the GDP. And the only way to do that is reintroduce inflation. So I do think that you're going
Hmm.
to see interest rates come down not only on a nominal basis, but continue to dive deeper and deeper on a real basis into negative territory. That means the
Hmm.
opportunity cost of owning gold will become lower and lower. And I think fundamentally that will drive the gold price to historic highs. We've already achieved historic highs this year, and we've achieved even bigger highs in virtually every major currency in the world. And now the US
Hmm.
dollar is seeing gold prices go up to all time highs. I think $3,000 an ounce going forward. And you and I talked about the 2003 to
Hmm.
2005 period, what happened to gold
Hmm.
at that point. We see the same type of performance uh, potential in the gold price, which would see gold almost effectively double from where it is today. So we do
Hmm.
believe that gold is going to do fundamentally much better as interest rates come down on a nominal real basis. Copper, we have a component of copper in our portfolio. We talked about the Cozamin mine
Hmm.
opportunity that we bought a royalty on last year. We fundamentally believe in copper. We like to have a bit of diversification in our portfolio, even though vast majority of our royalty revenue is precious metals. But copper is fundamentally supported by the decarbonization effort globally. Um, and copper is the biggest battery metal in terms of consumption in the world. It's required fundamentally for all the electrical vehicles. It's probably the most
Yeah.
significant metal required for EVs. And it's required for transmission lines and electric grid generally. As the world continues to electrify, more and more copper will be required. What we're seeing, though, is significant supply disruptions in copper, not least of which is what happened
Hmm.
in Panama recently with First Quantum's Cobre Panama mine, the
Hmm.
10th biggest copper mine in the world, is shut down by environmental NGOs, which is nonsensical. If they're really looking to achieve
Hmm.
decarbonization, we need more copper mines that are responsibly operated as First Quantum operated Cobre Panama. And so that means there's going to be a supply squeeze coming on. There's no major projects under construction, none on the drawing board. And there's more and more of this NIMBYism that's occurring, not in my backyard. Don't build a copper mine. Well, we can't achieve our decarbonization objectives globally until we build more copper mines, and we're not building them. That means we're going to have a supply squeeze that will drive copper prices to historic highs. What it tells you is we're not at the incentive price for new copper production, for new copper development.
Hmm.
Because if we were, we'd see more copper projects developed. So probably means that we
Hmm.
need copper in double digit territory on a per pound basis before we start to see new copper mines built.
Oh, really? So you think really the incentive price is that high?
I think it has to be north of $10 a pound in order to drive
Wow.
new development. And remember, the lead time
Hmm.
to development is long. It's typically 10 to 15 to 20 years. If we want to accelerate that,
Hmm.
we need
Hmm.
considerably higher copper prices to incentivize development on a more expeditious basis. It needs to
Hmm.
be economically attractive
Absolutely.
for all stakeholders. That means we need
Hmm.
much higher copper price. And I'd say it's the same thing for gold because gold reserves are
Hmm.
down 40% from their peak in 2012. They
Hmm.
continue to decline. All the industry has been doing is cannibalizing itself, buying each other out
Hmm.
to sustain unsustainable production
Yes.
levels. 25
Yeah.
years later, from when I started in the gold business in 1998, Barrick and Newmont are at the same production level they were 25 years ago. And all they've been able to
Hmm.
do is buy other companies out to sustain an unsustainable production level. And so what that tells you is their production isn't going to go up anymore. The reserves aren't going to go up anymore. But what will increase is their share count. It'll go up exponentially as they continue to take
Hmm.
over other companies, sustain levels that are suboptimal in production and reserves.
Hmm. How do you see that in silver? Because I think silver is even much more critical, isn't it?
Well, certainly silver has more industrial utility, but what I would also
Hmm.
tell you is that silver is a proxy for gold. And typically, in a bull market where the gold price is really roaring, the silver price is significantly under outperform, I should say, the gold price because the gold to silver price ratio starts to narrow. Today, it's close to 80 to 1. In a bull
Hmm.
market, it's more like 40 to 1. So, what that tells you
Hmm.
is that the silver price has the potential to outperform the gold price twofold as the gold price starts to gain momentum.
Hmm. Hmm. Absolutely. No, and I mean also given the fact that we are now in the fifth year in a deficit, and if I accumulate the last years altogether, I think we talk about now 680 million ounces real deficit, yeah,
Yes.
which had to come from somewhere because it was
Yeah.
used, right? So don't you see even the physical pressure much higher in silver in addition?
And I don't think that's a unique phenomenon to silver. I think we're seeing
Hmm.
supply squeezes right across the industrial metal complex and the silver
Hmm.
complex and the precious metals. That tells me the lack of development, the lack of reserve growth, in fact, reserve shrinking across the entire metals complex tells
Hmm.
me that we're far away from where incentive prices are for new gold mine development, new silver prices, new silver mine development, and base metal mine development. The gold price probably needs to be at least north of $3,000 an ounce, and silver price north of $50 to $60 an ounce to incentivize any new development of silver,
Hmm.
gold, and copper mines. So we're way away from
Hmm.
incentive prices for all the major metals in our view, the LME metals.
Mm, definitely. Super. All right. So I would say future looks good. 2024 has started. Let's rock it. And yeah, we look forward when you really collect more and more gold and bring up your revenues and the profit. And of course, then restart the dividend payment. That would be great.
Well, thanks for having
Super.
me on today,
David,
Johan.
thank you very much, David. Yeah, ladies and gentlemen, that was David Garofalo, the CEO of Gold Royalty, and you heard it. Things look really good. Don't forget the share price is really on the low side. The share price hit our calculated low target of around 120, $130. And to be honest, it is a fantastic entry point, and I'm buying also in the market. I am a shareholder already, and I bought at much higher prices, but I really believe in the company because I see the value and I see the growth opportunities here. And as David alluded to, this year probably $12 million of revenue. The cost basis is also shrinking, so they are cash flow positive. They will make money from now on. And don't forget, in the next years, a lot of mines are going into production where Gold Royalty has significant royalties. So that means they will collect their gold, their silver, their copper, and the money, of course, and this would help a lot for the stock performance. So really make sure you have a look on that fantastic company. Thanks for watching us, and I wish you a great, happy new year and healthy and prosperous new year. Thanks, and bye-bye from Switzerland.